Hello, folks, and welcome to an Onchain update for the 28th of August. And this one's a pretty special one. You may have heard me kind of referencing a piece of work that I've been working on in the background for some time. And by some time, I mean over 18 months, alongside Dave Puel from ARC. So we finally released Cointime economics. So I can actually start to explore these ideas and talk about it. Really excited about this project. It's it's a new framework for how we can think about Bitcoin. It's a tool that helps us correct and understand the true economics. And there's a lot of questions out there, like how much does mining actually dilute supply, and how many coins are lost, and how do we account for these things in our models? What is the true cost basis for Bitcoin? And this essentially goes, I think, some leaps in the direction of actually answering all of those questions. So today is very much going to be a bit of an introduction, a bit of a primer to what this thing actually is. And just exploring some of these kind of initial primitives, kind of getting our mind into the game, and over time, we will start to use this more and more. So what is Cointime economics? Well, it's a new framework that builds on two different components of the supply, the coin and the time, right? Coin is the value that's moving around, the BTC volume. But if you here's the kind of core concept. We talk about this often, but this is kind of formalizing it. If a coin was acquired yesterday and it gets spent today, do we really care? Not really. If a coin that was acquired back in 2012 was spent today, it means a lot more. So what we do with Cointime economics is we time weight the volume. We look at how long the coin has been held, and therefore when it's spent, we assign more value to it. Now, conversely, what we also do there is a coin that is long dormant, we can kind of discount. The assumption is that it's not really actively participating in the modern economy. So therefore, does mining supply really dilute? And the most extreme case of this is a lost coin. A lost coin will just forever be accumulating time, right? It's never going to move. So does mining really dilute lost supply if it can't even respond because it's lost? Probably not. And what that means is that mining is actually diluting a larger portion of the active supply. So Cointime economics is this really cool framework where we can essentially, and it's very simple from a mathematical standpoint, actually, it's very simple. We can essentially dilute or kind of amplify the impacts on the active supply and discount the effects of what we call the vaulted supply. And for those of you who have already had their eyes glaze over, this is the answer in meme format. Coins are time. This is actually the first thing that I put to pen and paper when I sat down to actually write this thing. So anyway, what we're going to do is do a quick snapshot of what Cointime economics is. We're going to go through what the primitives are, the metric. We're basically just going to go through the Cointime economics dashboard just to give you that initial flavor. And as I said, we will come back and we will explore this quite a bit more over recent months. Over coming months, because it's an interesting toolkit. It certainly has some useful applications, which we'll touch on today. So let's get stuck into it. Okay, so what is Cointime economics? So I mentioned the concept of investor holding time, and you've probably heard the term the coin day. This is actually one of the oldest Bitcoin metrics. The Bitcoin day, as it was once known, was kind of invented, I guess, talked about back in 2011 in the Bitcoin Talk forums by an anonymous folk called Bytecoin. So the coin day, as it became to be known, is every Bitcoin in the supply accumulates one coin day per day. And this is kind of a measure of holding time. When that coin is spent, we consider it to be a coin day destroyed, right? Because it's essentially spending all of the accumulated holding time. It gets reset to zero and it starts reaccumulating that coin time. So what the concept here is that we can actually measure the economic weight by how long a coin has sat dormant. Now, try and think about this from every single coin has like a health bar, right? The moment that it's spent, its health bar goes to zero. And that health bar is the entire accumulated time up to that point. Coin is spent, it destroys all that time. And from the time when it gets mined into the next block, it starts accumulating and building up its health bar. So for every single coin, it's got kind of a red component, the spent part of the health bar, and a green component, which is the amount that it's accumulated since that point. So we run that calculation across the entire network. Now, the problem with the coin day is that, and mining is probabilistic. Sometimes there's 144 blocks. Sometimes the block time is 10 minutes. Sometimes it's 9 minutes and 30 seconds. Sometimes it's 11 minutes and 2 seconds. So within a single 24-hour clock time period, there's a non-uniform amount of blocks mined. And not only are they non-uniform in the count, but they're also mined at all different timestamps. So one might have one mined at 9:30, one might be not mined at 9:32. You know, because blocks are random, every day is actually non-fungible. It's unique in the amount of coin days inside it because of how many blocks are inside it. So to really actually start this whole thing off, we actually came up with, well, what is the unit of time in a Bitcoin environment? And it's actually the block. The block, a single block height, right? Every time a block is mined, we actually don't care about the clock time. How many blocks has it been since that coin block has moved? So we come up with the coin block, the amount of Bitcoin, so half a BTC. If it is mined into a block, 5 blocks later, it's required half a Bitcoin times 5 blocks. That's going to give you your coin block volume. So we have 3 different components. Coin blocks created, which is literally every block height, whatever the circulating supply is, we have that many coin blocks added to the cumulative. We have coin blocks destroyed, which is every time a coin is spent, all of that health bar up to that point, that coin time is spent and destroyed. And whatever's remaining, coin blocks created minus coin blocks destroyed, will gives us the coin blocks stored. That's the economic energy still in the system. So just to give you, this is a view on those. This is the cumulative view. This one here is actually looking at them each individual trace. So coin blocks created. Here's one thing that I found quite interesting. Look how coin blocks created actually follows the price. This is not because it has any semblance to do with price. Price is not included in this. This is actually mining. The amount of blocks being mined each day obviously changes the amount of coin block creation. So you can see that we get these large drawdowns in coin block creation when fewer blocks are mined per day. We're actually seeing that this chart here is showing us when mining is slowing down. We're seeing that mining picks up, it slows down, it picks up. It generally follows. The general pattern is the circulating supply curve. But here's the China ban. When all of those miners went offline, like 52% of them, suddenly blocks coming in much slower. So the coin block creation falls off a cliff. This is actually showing us the boom and bust of mining cycles because of how quickly blocks are coming in. Coin blocks destroyed, on the other hand, is really showing us about the investor behavior. It spikes during bull markets. And this is the same as coin days created, but at a more kind of a fungible unit of account, let's call it. And you can see coin blocks destroyed falls off during bear markets because fewer people are spending. You get capitulation style events where you get large expenditure of coin blocks. So you can start to see that we've actually mapped out what's going on the production side and what's starting to go on in the investor side. And again, if you subtract coin blocks destroyed from created, you get coin blocks stored. So generally speaking, coin blocks stored is above 1 most of the time. Except note that sometimes coin block storage is actually negative. And that is because coin block destruction exceeds creation. It is almost like dipping into the network's savings, that held time, that hodled supply. This is actually showing you that at peak bull markets, we have negative coin block storage because it's spending from the reservoir. Now, the reality is that there's only so many coin blocks stored, right? If every single coin was spent, you would destroy not technically all, but almost everything in terms of the entire supply. But obviously that's a bit of an edge case. So this is kind of where it dips into savings, and you can see these extreme events. So you could probably start to already see, just based on this sole observation here, we can start to spot capitulations, inflection points, periods of time where coin block destruction is really starting to pick up. And you can start seeing we've got production and demand side as viewed through the lens of time, which is a kind of interesting concept and really where all this gets built off. Now, the other primitives that really matter. So strangely enough, this whole piece of work comes off the back of work by Thomas Blumer. He came up with liveliness and hodled and lost coins as far back in 2018. And it's one of those things that kind of sat there for 5 years. I certainly always appreciated liveliness. I've talked about liveliness, but even I didn't fully understand the magnitude of what liveliness really is. And this piece really goes to the full depth of understanding that. So liveliness is just taking the ratio between cumulative, all of the coin block destruction that's ever happened, and all of the coin block creation that's ever happened. Let me just quickly pull up the report. And here we can see that we have liveliness, all-time coin block destruction, right? cumulative, and all-time destruction over creation. So you're basically looking at a ratio of how much of the whole network, that health bar concept. Up the top is the red, down the bottom is the purple, and you're left with that kind of how much of the network has been spent. Now, we also come up with, obviously taking the inverse of that, 1 minus liveliness, because liveliness can only go between 1 and 0, and you get what we call vaultedness, which is the total sum of coin block storage over coin block creation. Let me jump back to the charts. So what you can see is that these move inversely to each other. And what these are basically doing is tracking between 1 and 0, how much of the overall network has been spent and how much has been stored. Now, what you can see is that we go through these periods of plateau. And by the way, there's a whole lot more detail, right? If we were to zoom in on this particular area, you can see there's a whole lot of periods of hodling, right? Increasing vaultedness, decreasing activity, periods of capitulation where coins come back to life, increasing hodling in a bear, increasing expenditure, reducing vaultedness during the bull market. We can take the ratio between those two, which gives us the amount of activity to vaulting ratio. And this is like liveliness, except it's unbounded. It can trade essentially to any value from 0 to infinity, but you can see really violent spikes. You can start to actually piece out hodling behavior, spending behavior, hodling behavior, spending behavior. Gives you these nice dynamics. Now, there's a whole bunch of things here. I won't go into the nitty gritty of all of these. What really matters for the next step is that we can take liveliness and vaultedness, and here's where the Cointime component and the coins at time meme comes from. So whilst we can go from liveliness and vaultedness, we can actually convert that into a supply domain to bring time into the supply region. So here we are back in the report, and this is the original formulation of hodled and lost coins, which we now call vaulted supply. So hodled and lost coins is the circulating supply times vaultedness, or 1 minus liveliness. This was the original metric. And as you can imagine, if we replace vaultedness for liveliness and we get rid of the 1 minus, circulating supply times liveliness is the active supply. Now, this is where things get a little bit abstract, as if that's not already the case. But the concept here, let me go back to our chart. So the notion here, I'm going to turn off circulating supply just for a second, is that we can see that vaulted supply, what it's basically doing is it's taking all of the time in the network, and we don't care about which UTXO it is. We don't care about which coin it is. We don't need to know which coin is lost, hodled, and none of it. All we care about is out of the entire network, how much of the health bar is spent and how much of it is remaining stored in terms of that time component. And hodled supply, or vaulted supply, hodled and lost coins, is essentially the stored component. And the red zone is the active component. The other way to think about this is the economically inactive supply. The supply that does not, will not, has not responded to market events, right? You can actually see that whilst our long-term holder supply and hodl waves, they kind of bounce all over the place. Generally speaking, these metrics are fairly stable. They go through periods of repricing, but generally speaking, they're kind of consistent. They don't change a great deal. They're not volatile metrics. So what this is really telling us is how much of the supply is unaffected by new mining. For a good example, the vaulted supply simply doesn't care about new mine supply. It contains lost supply, it contains Satoshi, deep hodled, long dormant, people who just don't care. It's the supply that the market can comfortably discount and not worry about it being spent. The active supply, on the other hand, these are the coins that are constantly moving around the system. They're economically active. They're going to be trading. They're going to be influenced by new dilution, all that kind of stuff. And the important part here is just that very simple concept. Supply that is economically active, supply that is economically inactive, being vaulted and an active supply. Sorry, I've jumped too far ahead here. I'll spare the details. This is kind of the when we start moving into, here's kind of just to bake that concept in. We look at this from the economic standpoint. So what we have here is the inflation rate. Now in purple, we have the nominal inflation rate. This is literally circulating supply is kind of the denominator, and we're looking at how many coins are mined, and we assume that it dilutes the circulating supply. Now the problem with that is that we know that many coins are lost. So is it really fair to dilute the coins that are lost? Probably not. The mine supply doesn't really affect those coins because they're never going to respond. So then we have our Cointime adjusted inflation rate, which only looks at the mined supply going into the active supply or the economically mobile. Now, we can actually look at this from the stock to flow ratio as well, right? Where we have our stock to flow that continues to climb, right? Continues to climb. What's quite interesting is note how Cointime adjusted inflation rate is actually higher in the modern era. It was lower back in the day, which also means that our stock to flow is higher. Now, what this means, even though there was 50 BTC per block, Satoshi was mining a lot of these and early miners, and they didn't spend them. So even though, remember, stock to flow, a higher value is scarcer. Even though there's lots of coins being mined, very, very few of them hit the market. They weren't actually available. So the scarcity was actually much higher in the early days than we initially anticipated. In fact, it was at the same level as just before the second halving. The amount of scarcity in the system, because those coins were mined, but they didn't actually get spent. They didn't enter the economy. So as a result, our inflation rate was actually lower than what you would otherwise measure. Now, conversely, following the second halving, and this here is a really interesting dynamic, look how the 2017 bull market mobilized and brought a whole lot of coins that were previously inactive at $20,000. People are digging up their couch cushions looking for passwords to find those damn private keys. I'm going to go and dig through a landfill to find my hard drive because now Bitcoin has value. The incentive to bring supply back online increased. So what that also means is that the mining is actually more dilutive, almost to a factor of 2x, than the market believes. Our scarcity in yellow is actually lower than what you would measure directly from the stock to flow model. Now, whilst I'm not going to defend the stock to flow model as a pricing model, Cointime adjusted stock to flow includes demand because coin block destruction is demand. It captures the demand side of the equation. So in many ways, this is well, in my opinion, the correct interpretation of the stock to flow model, and that it is self-correcting, or the stock to flow ratio, that is, because it is self-correcting for the true demand in the market. And really, what is this capturing? That the stock is what matters. The dilution is relative to the stock. And in this case, we've bifurcated the stock into active and inactive, and we're looking on the economic calculations purely at the active supply. So I know there's a lot there. Again, we'll dive into this in more detail. I just want to kind of give you the initial snapshots. Now, this is the kind of the final one that I want to touch on. I might touch briefly on lost coins because I think that's an area of interest. But you've probably heard me talk about the fact that our realized price isn't really the cost basis of the market. And the reason why this is, if we look at the realized price, it's the realized cap, which is correct, all the coins multiplied by the price when they last moved. Now, Satoshi's coins are all valued at 0 because they have never moved, right? And they didn't have a price when they were mined. So as a result, Satoshi's coins, they've never really contributed to the realized cap. But when we calculate the realized price, we do realized cap divided by circulating supply. The denominator contains all those coins that have never contributed to the numerator. It's kind of a little bit unfair. What we're doing there is we're saying that, Satoshi's coins, and at the time of writing, the MVRV was at 1, break-even level, right? So assuming that price was at break-even level on the realized price. The problem with that is that Satoshi had 36 billion, with a B, dollars worth of unrealized profit. That means that some other guy who bought recently and is economically active in the 2022 cycle, they've got to be carrying 36 billion of losses just to nullify Satoshi's profits, which is kind of wild, right? So we've actually been marked to get to break-even level. You've actually got $36 billion of losses offset by the profits of coins that will never spend and never move. So what Cointime economics does, it removes in a very elegant way all of those coins that have not spent, right? It only looks at the investor component, the coins that have actually spent and inside the economy. And what you can see, I mean, here's kind of, I think this is the most mind-blowing part of the entire analysis. You'll often see we look at means and medians. Well, the mean and median of this particular model, what we call the true market mean, it is at 1 and 1, very close to 1, meaning that over the long arc of Bitcoin's history, the AVIV ratio, which is just simply the ratio between price, kind of like the new MVRV. Note how it basically slices straight through the middle. We spend half of our time above it, half of our time below it. And the mean, that's the average, we're half and half. And on the median, right, the middle value, we are half and half. It's perfectly distributed around a break-even level of 1. So what the true market mean is capturing is the actual cost basis of the market. It gets rid of all Satoshi's coins, and it only looks at the economically active component of the supply, as well as coins that have been spent after their initial mining. So we get rid of the thermo cap. We only look at coins spent in secondary markets, and we compare it to the active supply. And what we essentially get is these beautiful little touch points on people's cost bases. It forms this kind of centerpiece of the market overall. So what you can see is that we have recently rejected off this level. This is about 30,500 from memory. We previously used the adjusted realized price, which kind of a little bit of a, it's not quite the best way to do it, but we subtracted coins older than 7 years. That was up here at 32,000. So this here is basically telling us that we are still underneath the average cost basis of the Bitcoin market. We are heavily weighted by these folks up here that bought, and we have removed the offsetting of Satoshi's coins. So a really, really interesting tool, something that we can explore in a lot more detail. We'll turn this into pricing models and be using it as we move forward. Now, the last thing I want to touch on, because I know I am conscious of time, is some interesting dynamics. The first one is this kind of notion that here's that vaulted supply. This is the hodled supply. Here we have the supply and profit, right? Notice how we find a bottom very close to hodled and lost coins or vaulted supply each and every cycle. It gets a little bit better each time, and this was a 90% drawdown. This was an 85. This here was a 75. We're getting slightly better over time, but this is kind of telling us that the hodlers put the floor in. The active supply also intersects the supply and loss, obviously because they're both inverse to each other, you get the same effect. But what this is telling us is at the bottom of bear markets, pretty much every single active supply is in loss. AKA, Bitcoin bear markets are brutal and pretty much everyone gets cleaned up. It's only people from the previous cycle who stick around, right? And actually have coins in a profit. That's not on the average cost basis, though, as we saw before. So kind of interesting how we're getting these intersections here and there that show what's going on. Now, the last thing I want to touch on is we go through, and there's a lot of detail about this in the report about estimating lost coins. We try a bunch of these different methods. All the green curves are like upper bound models. The red models are highly certain but lower bound models, right? Coins that we actually know are lost. And then we use Cointime economics principles to see what the best estimate really is. And what we essentially find, I won't bore you with the details, I'll leave the table in the report to kind of capture itself. But what we essentially find is that somewhere between about 18 and 24% of the Bitcoin supply is lost, which is kind of a big number, right? That's a pretty remarkable spread. So let me just bring up the actual table itself. So we look at these different estimates, right, for the grouping of lost coins, right? The lower bound, we're talking about 9%, 1.17. For our best estimate, right, we've got two different models for our best estimate supply. We're talking about 18.5, right, 3.9 million Bitcoin, or 4.8 million at 23%. So we're talking about a non-trivial amount of supply that is truly lost. And if we just factor this in, right, if we think about, let's just take something in the middle here, let's say about 4 million Bitcoin, that means we're talking about 17 million in terms of total circulating supply that can ever essentially be acquired. But it kind of gives a bit of a gauge on the overall scarcity of the system. So anyway, that's kind of the full details there. Bit of an overview. There's a lot of information in there. It is by far and away the most abstract, bizarre, odd thing I've ever had to wrap my head around, and yet at the same time, the mathematics of it is actually very, very simple. So it's one of those things where it's kind of just this organic thing. I really do file it under a discovery. I don't believe it's an invention. We kind of found this. It's always been there. It's just literally about putting the thought and rigor to it. But I will leave a link, obviously, to the report itself in the description for this thing. But look, give me some thoughts, right? I know there's a lot in there, and I'm certainly not expecting everyone to kind of wrap your head around it. But we'll be exploring these applications in a lot more detail, because I think there's something really interesting here. And at the most, what it does, it helps us understand the true economics of the Bitcoin market. It helps us really frame up which part of the supply is meaningful, which part isn't. How do we discount lost coins and amplify impacts on active supply, and kind of just make that distinction. So anyway, hopefully you found that useful. We'll explore this in a lot more detail. Hope you had a great week, and I'll see you in the next one. Cheers.